So from this class on, we're going into analyzing the income statements. Then we're going to analyze the balance sheet and the cash flow statements. I am going to show you how to do it. I'm using NFM and Angostura, and I have created a folder with several different companies. I'm assigning you to a group. There'll be 8 groups. Now, each group is responsible for one of the companies within that folder. So from the analysis, you are using your company as a group and you're analyzing it against another company within that same folder. I would give you your folders. I would assign you your company and your competitor or cross-sectional first company to compare it with. So you're doing that for the income statement. You'll be doing assignment for the income statement, for the balance sheet, and for the cash flow statement. So this is taking you to the next assignment, which is a PowerPoint presentation. After we analyze those 3 statements, right, I'm going to show you how the how to perform a equity analysis, a fixed income analysis through the information that we use to analyze these statements. And then you individually going to create your PowerPoint. This is how I know that you worked within your group. Right, so the information from your assignment is going into your PowerPoint, and then finally you're going to do a presentation of the analysis that you found. Right, your presentation would be in the form of a video, 3 to 5 minutes at least, and you would upload it. Right, so you must take part in your group or you must do the assignments. Right, this is preparing us for proper presentation. You'll be getting marks for your presentation, PowerPoint, and as well as how you present the information as well. Because 40, right? When we leave USC, we must be able to say we know how to analyze statements and we can present it. So we're looking at the income statement, and we know the income statement is that statement that tells the company's financial performance. It gives us the financial results of the company's business activities over the period of time. So the business activities is what the company is about, what they open business to do. National flour mills, processed wheat, and they make products, flour and wheat products. We also see that they do transportation and feed, right? So, you know, in your annual statement, will tell you what this business is about, what their activities about. So the income statement basically tells us the financial results from those activities. It communicates to us how the revenue of the company generated. So the company will generate the revenue from sales or service based on the company, sales, and what cost it incurred in connection with generating that revenue. So yes, you make money. A lot of people look at the money that you're making and say, oh, they're making a lot of money, but there are costs involved to generate that revenue. Also, this statement is sometimes called not the income statement. You will see the statement of operations or statement of earnings or profit and loss. They didn't have this one here, but I see comprehensive income. I see a lot of them are comprehensive income. And the main formula in the income statement is revenue minus expenses equal net income. Oops. I want to share the statement one time so we can go through it together. You see my screen?
Yes, ma'am.
Yes, miss.
So here I have NFM income statement. Here it's called Consolidated Statement of Comprehensive Income. And it tells us the results of the company's business activities. So here we're looking at performance, revenue minus expenses. Right. So who would analyze an income statement? Investment analysts. They intensely scrutinize companies' income statements because they want to make an investment. They look at this income statement. Equity analysis are interested in them because equity markets often reward relatively high or low earning growth companies with above average or below average valuations respectively. So those are people who look into acquire new companies. They would scrutinize or look at the comprehensive income statement. Fixed income analyst examines the components of income statement, past and projected, for information on the company's abilities to make promised payments. So these are banks or the companies that give loans. They look at the company's income statement. Now we are going to look at the income statement. I think a class before I asked if anybody had shares, but once you have any type of savings in a credit union, in a unit trust, mutual fund, any type of mutual fund in the bank, you are invested in shares. And so the back end or the people in the back, they look at the company's financials to know where to put your money. So yes, you are invested in stocks, right? And the analysts use these income statements to determine the type of investments. Components of the income statement. We have revenue. So are you seeing the revenue figure in the income statement? Where's the revenue? How much is the revenue for 2020?
Miss 417,906,000.
Right. This refers to the amount charged for the delivery of goods and services in the ordinary activities of the business. Revenue is sometimes labeled as sales. So if the company is not into selling buildings, but they sold a building, you would not see it under revenue. Revenue only pertains to the activities of the business. Here I have Angostura. Revenue with contracts with customers. Are you seeing it there? So the first line is revenue. Here I have Angostura. Angostura as well, first line, revenue. So everybody's using revenue. Revenue seems to be consistent within this market. Prestige Holdings, look at their revenue. It's in, but that's millions, 896 millions. So I have these four companies up. The next section is expenses, because we want to look at the performance, which is the profit. Revenue minus expenses gives us net income. Expenses of the company, they come in the categories. So the category we look at is operating, and operating expenses would mean selling, distribution, salaries, marketing, anything to keep the business afloat will be operating. Rent. The next main area we look at is interest and taxes. So I want you to get familiar with the statements. You could tell me to stop if I'm going too fast, right? So the statement is showing, are you seeing the operating expenses?
Yes, miss.
Right. What about interest expenses?
Where is that, miss?
Right. Finance. Finance costs would be, right, so this statement, and I think in most of them, they call it finance costs. This is the interest that is paid on loans, right? So it becomes part of the business yearly expenses, but it's not necessarily needed for operations. So it's placed separate. So if it's not interest, you'll see finance. So you've seen finance cost there.
Yes, miss.
That's one of the major expenses of the company. And then the other major expense is income tax or tax expenses. Are you seeing tax expenses there?
Yes, miss.
Income tax expense.
Look at Angostura. Interest expense. Here it is called finance. Operating expenses. Are you seeing the operating expenses? Selling and marketing, administrative, expected credit or loss, right? Profit, some tax, tax expenses. And if you look at the order, you would see from revenue, they take away cost of goods sold. And cost of goods sold, I didn't talk about that expense, that should have been here. Cost of goods sold is basically the direct expenses towards production. So in NFM case, it will be the wheat, the direct wages, labor,
The feed.
the feed, right? So those things that are part of what the business do, those are the expenses. Then you get gross profit. So I missed that part. So revenue less cost of goods sold give you gross profit. Then we're interested in all the other expenses, and we categorize them in three: operating, interest or finance, and tax expenses. From that, you'd get profit for the year. So profit for the year. So people ask me, Miss, what profit to use? You're seeing so much profit, and we're going down, right? The profit for the year comes after taxes. So after the company takes out, gets its revenue, takes out its cost of production, takes out its operating expenses, finance, and tax, you get profit for the year. I'm going to explain the others in a while. Just to look at it again, Angostura. Angostura one is listed clearly. All right, revenue, cost of sales, gross profits, operating income, other expense, finance costs, taxation. We pay a lot of attention to it. We want to see, looking at the statement, all right, the company generated all this revenue. What expenses took up all this revenue and in the end resulted in such a profit? What are those expenses? As managers, should we be looking at monitoring something here or analyzing it? Should we be looking at monitoring something here to say this company is very high tax? The operating expenses is too large, right? NFM is in colored. So you see the operating profits. We see, they call it net finance costs, so that's interest, and then income tax expenses. So you see all the statements are consistent, and then you get your profit for the year. Do you see that? Yes?
Yes, miss.
So you know how to read this income statement, right? Then we have these non-reoccurring items and non-operating items. I'm just mentioning it here so that you would understand why it's here. But when we're analyzing, we are only interested in the profit for the year. The reason why these non-reoccurring items that come after profit for the year, they are items. If we go through the IFRS principles, we realize that the company, they have to tell us how they got other income. So they may not be in the business of selling or getting any benefit from insurance, maybe selling for insurance, right? That they're not in that business, but they may have done it and they got money for the company. So it must be reported. So these other items that are not part of the company's regular activities are reported below the profit for the year. Understand? Anybody could say why we would not use them. Why do you think we don't use them in analyzing? No thoughts? Should I repeat?
Yes, miss.
Yes, these information below profit for the year is not the general activities. You won't see them happening every year. It's a one-off activity. So they must report it. IFRS standards say that they should report it within the the financial statements. But why, as analysts, we do not use them in our analysis? Why would I be interested in 23,456 as opposed to 20,393? Shouldn't that be the profit for the year? All right, let me tell you. So it would be unfair if I'm looking at the company and I'm looking at another company, and one company may report a higher or a lower profit just because they had a loss in selling a piece of land, right, or a gain in selling some vehicles. It's not part of their business, but they did it. So it's a one-off. So we don't use it to analyze it because it won't give us correct analysis. We prefer to use the profit after cost of sales, operating expenses, interest expenses, and tax expenses. Right at the bottom of those other income, other comprehensive income, we look at this figure here called, or this heading called earnings per share. Anybody know what that is? Paula. I'm picking on you because you're a finance major. Earnings per share. Anybody remember what that is? And those who just came out of principles of finance.
Miss, shares that were sold.
Share again. All right, so it is shares that were sold, but this earning.
Is it shares that the shareholders of the company that's own?
Yes. So it's how much per share. So if you have 10 shares, it tells you what percentage of the ownership the company you have. So in this case, 20 cents per share. So if I have 5 shares, or $20, I say 20 cents, $20. So if I have, yes, it's cents, 20 cents, it's supposed to be cents. If I have 5 shares, then I have $1 worth of the company. Then you have diluted earnings per share. So in some cases you see diluted. Diluted means that if the company will dissolve, then this is your percentage that you will receive. Right? Should the company decide to close off, this is the percentage you receive. And I've seen most statements, the basic earning and the diluted earnings are the same. So shares, remember, there are ordinary shares, there are preferred shares, right? And ordinary shares. You have voting rights, preferred, you have no voting rights, and you would get dividends. So if there's preferred shares here, you would see it on this statement. Let's look at the others. Agostini. Agostini has earnings per share, which is basic and diluted. Now, how the company come up with this earnings per share? They take the profit for the year and they divide it by the number of shares. And that's what gives you your worth. How much you're worth, how much you have, how much you own in this company, right? So this is what earnings per share. Profit for the year divided by the number of shares.
Question is,
Makes sense? So if the company has a profit, and this is how much shares it has, right? If we divide it, it tells me, well, this is what I have. Question.
they don't show the number of shares.
The number of shares is in the balance sheet. We'll get to there. Right? We go more into the analysis. So if you're looking to buy a share in a company and you see it listed on the share market, on the stock market for $200, and you look into the income statement and you see $1.83, you may have to wonder if it's overvalued, undervalued, right?
Miss, one more question.
Mm-hmm.
Would we need the calculation for in-group activity, miss, for the share?
For the earnings per share?
Yes, miss.
No, I would give it to you if it's necessary, but it's just here. So we're looking at the income statement, right? To identify the factors. We would need this figure to work other ratios, but you have to know where to find it, right?
Thank you.
So I'm just familiarizing you with the look of the income statement. So when that time comes for the analysis, you're clear where everything is. This is Angostura. Again, all these other items that they're doing, you see they have loss of the year for net tax, gains on evaluation of land and building, right? We're not concerned about that, but here they have dividends per share. So in this case, I think they have preferred shares. So each shareholder gets 17 cents for each share that they have. And their share value is worth 71 cents in 2020. Let's see Prestige Holdings. Prestige Holdings, $29.01 is the price of a share. Now, if you go to the stock market, you might see the share price for more than that, right? Diluted earnings per share, 28.5, right? As if the company wants to dissolve. And again, familiarize yourself. Revenue, cost of sales gives you gross profits, operating expenses, finance costs, taxes gives you profit or loss for the year. In this case, whoever is doing this company, Prestige Holding, experienced a loss. Anybody can identify why? 2020? Or could guess why? Come, Rihanna, get to it, get to it. We're going into the analysis. You're with me?
Expenses exceed the revenue.
Yeah, it exceeded the revenue. The cost of sales, the gross profit is 294,803. And look at all the other expenses they have, but anybody could see why. Look at the revenue dropped. I haven't read the statement. I haven't read the report, but remember that time COVID, all the restaurants was closed. Could that be a factor? What do you think?
Yeah, miss. That could be a factor.
Yes, miss.
Yeah.
Yeah, so the group that will be doing this analysis, you'll have to determine, you know,
Read the financial notes.
see, yeah, what happened, what's happening with this, or the management notes, management statements. What happened that year? And you know, sometimes you hear commentators or us ourselves may say, big company like that and they can't pay their workers while they're at home. Okay, Gisham. Right. Sometimes we say these things, right? But we don't know what's happening in the background. Company operating at a loss. All right. We have common size analysis. So how do we do the analysis of this income statement? Through these two methods, called the common size analysis and the income statement ratios. The objective really of the analysis is to assess the company's profitability. How do we go about it? Common size state analysis. So common size analysis of the income statement can be performed by stating each line item on the income statement as a percentage of revenue. Now I have a template I put up there for us. Make life easy. So if you're not familiar with Excel, that's a good skill to develop. A lot of businesses, they want it. And even if you're into entrepreneurial, Excel is a good tool. So common size statement facilitate comparisons across time period, which we call time series analysis, and across companies of different sizes. So in the analysis, in common size analysis, we'll be doing two types. Time series, time will mean we're going to analyze 2020 and 2029. They can do more years, but in this class, we're just going to do 2 years. And we're going to analyze it cross-sectional with another company, right? A different company within the same industry. How do we common size? Income statement items divided by net sales. So let me show you the template.
Can you just repeat one more time? Income statement.
It's fine. Income statement items divided by net
sales, is that?
Oh. No, revenue. That's the wrong thing. Goodness. Well, they call it net sales. Revenue. Revenue. So I won't confuse you. Revenue. So here I have the templates. In my template, I copied over NFM statement and Angostura. I'm using these two companies, right? This makes life easier for me, right? So I put the information from the statements, right? Just the profit for the year, up to the profit for the year in each sheet. How do I perform a time series common size analysis? So here I have these items. Now I pulled these items and I want you to do the same thing because some statements could be very long and give you a lot of information. We don't want all that information. We just want the revenue, cost of goods sold, gross profits. You're going to total sales, marketing, and general and administrative expenses, right? If it's not listed in one item, might be separate, you're going to total it. Operating profits, interest expense, or I should put / finance costs, and income tax expense, and then profit for the year. So this information, I have it here. I'm conducting a common size analysis. My common size analysis revenue is 100%. What we are doing, we're comparing all the other items in the income statement to see what percentage of it is revenue. So out of the 100% revenue, how much of the revenue was used up in cost of production, cost of goods sold? How much of the revenue resulted in a gross profit? How much of the revenue resulted in sales? No, sorry, not resulted in. How much of the revenue was taken up in sales, general, and administrative expenses? Right, and how much of the revenue was paid in interest expense? How much was paid in income tax expense? So I'm plugging in a formula here. I plugged in the formula to divide cost of goods sold 304,452 divided by the revenue 417,906. Once I have that there, I just pull it down. So I have to put back in the formula and it comes up automatically. Now, if you are not familiar with Excel and you don't know how to use the template, you have to know how to do the formula, right? So you would take each item, 304,
put it over the revenue, miss.
divided by the revenue, right? So this is not an Excel class. I'm not going to be teaching Excel, but I'm providing the tools because we're in the digital age. to make the assignment and life easy, right? But it's just for you to understand why we are doing this. We are analyzing the income statement using common size, time series. So this is time series to identify how much of the items was used up in revenue. Because again, I said, we look at companies. So we say Prestige Holding is a popular company. They have so much businesses, they have so much money, we say that. But what are their expenses like, right? When we look, Shanice, 1 second. When we look at cost of goods sold, 73%, it means that 73% of this company's income was used up in cost of production. In your mind, is that a lot?
Yes, miss.
Yes, miss.
If you had money invested in that company, it might be a concern, right?
Yes.
Yeah.
Because costs can easily run away, just 26% more, and you'd end up with nothing, right? Right, so this is the reason why we do it, so we can see the figure as a percentage. Isn't it easier to see the percentage as opposed to the dollars?
Yes, miss.
Right, but then
Yes.
Yes,
we
ma'am.
can look at it from year to year and see if it's going up or down. So if we had a trend here with about 5 years, right? You would see, well, if it's consistently at 70 something, or if 1 year you just see 90 something, it'll be thoughts for concern. So this is how we analyze the income statement. Yeah, Shanice?
Miss, you could just go over how you get the percentage.
Every item on the income statement is divided by the revenue. So cost of goods sold, this 304,452 is divided by 417,906. Multiply by 100. Do you get it? Try it out. Take this item, gross profit 113,454 divided by 417,906. Right? So I pointed out some items in the income statement that we want to look at. So we want to look at our cost of production. We want to look at the operating expenses. How much of it is taken up, right? We want to look at the interest expense, the tax expense. So this company is the taxes going up, the interest going up, the borrowing. These things could tell you. General expenses, what is management spending the money? Where is the money going? So from this statement, you could already see, right? Where is the money going?
Cost of goods sold.
So,
We're seeing a reduction, right? So I made a comment. You have to comment on your findings. My comment is, the company has generated only 1% of its revenue in net income in 2019. So that net income you see in 1%, it means that for every dollar that company made, it made 412,476. So that's millions. I don't know, right? If they made that money, the money the shareholders taking home is 1% of that in 2019. And in 2020, it increased to 6%. Are you seeing what I'm speaking about? As a shareholder, I'll be very concerned with this figure, right? How much is the shareholders taking home? The company is making 100% and I'm getting 1% of the pie. But in 2020, they got 6% of the pie. Another comment.
Excuse me, miss. Miss?
Yes.
Yes, just one question on that. When making the comments, can you actually state that there was a 5% increase in 2020 when compared to 2019, or there's no need for the comparison in the comment?
Yes, so I have on the slide tell you what to comment on. So first thing you want to comment on is the comparison change, the change, right? You want to comment on the change. You want to comment on the change, and then you want to comment on anything that is significant. So you could comment on the net income. You want to be You want to know that. Cost of goods sold, you want to know that. Well, significant. The other significant figure I saw here was the cost of goods sold. So what is significant is that the cost of production, is accounting for most of the sales revenue in 78% in 2019 and a slight reduction in 2020 to 73. That was significant to me, right? The 73, it's bigger than everything else. Right, so you could comment on the percentage change and then comment on any significance. So a lot of people stop at the analysis, but they don't make a comment. What do you find? Yeah, so you tell me it's that, but what does it? And then you could also go through the management statements, which may tell you, this instance, the cost of wheat went up or something, right? So the cost of production went higher. In this case, if it was higher, right, you could find the answers to why some of the changes occurred in your annual report. You excited about this? No? Anybody interested in this kind of thing? This thing excites me. I love doing this.
Miss, not sure. Miss, I love that you love doing it.
Then we go to cross-sectional. So that's the time series. So time series, as I said, it's analyzing year to year. And this class, we're going to do just 2 years, right? We're going to make it simple. 2 years, 2020 and 2029. Cross-sectional now is across industry or company. In this case, we're doing company. So we analyze it NFM with Angostura. Angostura. So I put on this side.
Wait, Miss, so that's all you have to do?
Yes,
That's
and I
what
give
this-
you.
Oh,
I give you the tools. Am I lovely? I give you the tools, right? Another class, you have to sit down and work it out yourself, right? I give you the tools. So revenue now, on cross-sectional now, I list the items I want to examine. The main things: cost of goods sold, sales, interest expense, income taxes. Now I'm performing the same analysis, meaning the item over revenue, cost of goods sold over revenue, but I'm just doing it for the other company, right, for 1 year. So I'm just comparing them for 2020, all right? So NFM was 73%. But how did Angostura did in the same environment? Their cost of production is less. When I looked at the general expenses, basically within the same range, 20 to 25. Interest expense, Angostura had none. Income tax expense, Angostura was taxed more. We know alcohol is taxed more. However, Angostura
Net income was higher
they able
than
to
NFM.
retain 16% of their income, right? So what happened here? They make 100%. So let's say they make $1. So every dollar they make, 16% went into profits. 16 cents. And this will become helpful for you too. If you know you are running your own business, you'd want to know how much you're really taking home. After you take out all the expense, you sell a product for $20, how much is your real net income? This will help you, right, through this type of analysis. Excited yet? That's it. Ratio now. I told you this class easy. Ratio analysis now. So we can do, I'm telling you all these analysis, but we only need to do, if you have to do it for a job, you only need to do one because you're going to get the same figures. But we just need to know how to do it, right? So we have a time series, we have cross-sectional, and now we have ratio. 2 particular ratios we use to analyze the profitability of the company is the gross profit margin and the net profit margin. So you hear the term gross profit margin, and I explained to you already what is gross profit. Sales minus cost of sales, and we know it by looking at the statements. Sales revenue, as I'm saying sales, revenue minus cost of sales gives us gross profit. So we know where to find gross profit. How do you find gross profit? Margin, this is the formula here. gross profit divided by revenue. New share, new share. Nice. I have an example here of Amazon, and I taught that class last year. This is their common size statement. Right, so ratios. I'm doing gross profit first. All right, so gross profit is calculated by the gross profit divided by the revenue. The gross profit margin, it measures the amount of gross profit that a company generated for every dollar of revenue. It tells how successfully a company buys or produces and sells merchandise as a profit. So you'd see some companies with high gross profit, but low net profit. Because after they did so well, they bought a product for $100 and they sell it for $5,000. But then they have a lot of expenses and it lick up the profits. So we want to be very mindful about that gross profit figure. We want to know how much of it is resulting in how much of the revenue is resulting in the gross profit. So we take the gross profit figure and we divide it by the revenue. The higher level of gross profit margin indicates higher profitability and thus is generally more desirable. So in this case, NFM, so I have NFM on top, and again, I have the formula in. So what I do, I just went across to my statement and press equal, and I went across to my statement and just selected it and came back.
Miss, we not seeing that.
New share. Right. So I went across to my income statement that I have here. So I just press equal. So if you see my bar, you see equal. And I selected the gross profit figure on my statement. So that's what I'm telling you. If you put your statement in the Excel, it's easy for you to just maneuver if you know how to use Excel. If not, when you're comfortable typing, type in your figures, all right? Divided by the revenue, right? And I got 27%. Angostura, 47%. Angostura is giving a bigger profit margin, which tells me that it'd be more desirable. It is using up is minimizing its cost of production as opposed to NFM. Net profit now gives us the final profitability, right? In this case, net profit is 6%, and we also saw it in the analysis, the cross-sectional analysis and time series analysis, and the net profit margin is 16%. So all giving you the same answer, right? Try to keep it to no decimal places. If you realize the income statements, they don't have decimals. So configure your sheet to no decimals, round it off. So we could be on the same page. 2019, again, Angostura performed better. And that is it. Can you do this?
Yes.
Yes,
Yeah.
miss.
I think so.
Miss, you'll be giving us the format, you'll be
Yeah.
sending us.
Miss, we could do an example first before we do it by ourselves.
It's on e-learn. No, so
Once it's posted, I good.
the
Once
next
it's
class,
I'm recording, posted, I
the
good.
next class, I'm going to do it with you. So we're going to go into our groups and we're going to do it together, right?
Okay, good.
Yes,
During
miss.
the class time.
Will be
Okay.
chosen members.
Right? So I'll be jumping from group to group, giving assistance and, right, helping you all out, and you all would help each other out. That is it. That's analyzing the income statement. So I have 8 groups, but I just didn't put you in the groups as yet. 6 people to a group, and I have the companies assigned to you, and you're gonna do this. I'm gonna put it up
So
by
much inputs, right? one person have to do on Excel, or we each have to do our own Excel?
I would prefer that you all do it together and just one person, you can agree to one person to submit.
Okay, good.
Right, so everybody have the practice. And that's how we help each other. So let me just recap. Short and sweet. So net profit, also known as profit margin. So you may hear profit margin ratio or return on sales ratio, is calculated as net income divided by revenue. Net profit margin measures the amount of income that a company was able to generate for each dollar of revenue. A higher level of net profit margin indicates higher profitability and thus is more desirable. Right, so in your comments, in your presenting, this is what you're going to say, right? This is the net profit, this is what you get, and this is more desirable. Any questions? Concerns?
Miss, when are you putting up the assignment?
Now, we'll be doing the assignment in class on Thursday, right? So I will put it up. I just have to put the groups. But you have these statements. You have these
So I
statements.
thought we would have been able to see it before we go into class, you know, we could go over it and so forth.
All right, so I have it here, but I don't have the groups, right?
We choose our own groups.
No, I don't want to do that. However, the persons who do, nobody want to choose them.
Yeah, miss, you choose.
Right, so I have the groups and I have the companies that you're going to use. I'll do it tonight. I'll organize the groups tonight, and this is how I'll grade you. 1%, 5% up to your final grade, 1% for team participation, 1% for your time series analysis, 1% for your cross-sectional analysis, 1% for your ratio analysis, and for your comments on your analysis. All right, so that's the format I want it in. So please be in class, and those who are missing, remind them to be there as well. All right, you got to make sure everything right. And that's why you need to talk to each other to make sure you have the right ratio, you have the right calculation. And I have the Excel template there for you, so you knock it out. I'm going to do the groups tonight.